to begin our question and answer session. I will call on you after you raise your hands. As we do have a number of analysts present, please limit yourself to one question as a courtesy to others to make sure we can answer as many questions as possible in the time allotted. We'll have our first question from Neil Mehta at Goldman Sachs.
Well, thanks, and I'm looking forward to hearing more on an asset level. But you know, the chart that a lot of investors are anchoring to this morning is the free cash flow guide for 2030, which looks like it's $29 billion at 70 Brent at the middle of those fuzzy bars. And so I just want some, your confidence interval in terms of actually achieving that. We noted on the slides, you talk about greater than 10%, and 10% would get you to the 29. So just your thoughts on how much of this has been de-risked, and how much should we focus on the greater than?
So Neil, maybe I'll start and then let Eimear give you a little bit more details. What you'll see, or if you've already looked ahead at the slides, is at an asset level, Mark will go through and give you several numbers for the Permian, for Bakken and DJ, TCO, Australia downstream and chemicals, and that'll probably build you up to 80+% of where we're going to go. The confidence is really underpinned by the fact that most of this growth is in flight. We've got projects that are online and ramping. We've got projects that are in execution and performing well. And there's very little kind of betting on the come to get there. So Eimear can build it up for you kind of in a different way. But I'll tell you, at an asset level, we've got these battleship assets that are delivering today and ramping towards stronger performance tomorrow.
Yeah, Neil, your interpretation of the graph was correct. So it's close to 30. So, between 28 and 30 is the fuzzy bar. Let's break it down in terms of the segments. So think of upstream as contributing, 7% of the 10% CAGR, and the rest of the portfolio contributing the 3%. When we look at upstream, there's two main drivers there. One, there's production growth. So 2 to 3% CAGR is the production guidance that we've given. So we are growing through the time period. But in addition to growth, we're growing margins. And we're growing margins because of a few things in the upstream. Our oil weighting is higher. We're lowering costs across the system. And we also have higher entitlement percentages. So when you put all that together, we're able to increase the margin on upstream. So that gets you 7% of the 10. The balance is coming from downstream, chemicals, and even some power is contributing at the back end of the plan period. And within that 3%, think about 2/3 of it is really the downstream and chemicals piece. So that's how we get to the greater than 10% CAGR. And what I'd want to emphasize here, to Mike's point about confidence, this is a high confidence outlook. I mean, we can see the building blocks, all these growth catalysts we can see. I mean, my expectation, our expectation, and what we're working on internally is that it'll be greater than 10%. And so that's the breakdown.
We'll take our next question from Devin McDermott at Morgan Stanley.
Hey, thanks for taking my question. So I wanted to kind of build on Neil's question on the free cash flow growth. You highlight a sub-50 Brent break-even over the course of the plan, which is a nice reduction versus where you all are right now. But I'd imagine, given the free cash inflection in the near term of next year, the 10% plus free cash flow growth over the course of the plan, there's a pretty substantial reduction in that break-even over the course of this 5-year look that you're giving us today. So I was wondering if you could just quantify that rate of change for us, maybe in a more static dividend environment. How low does that break-even go through 2030? And then how do you think about allocating that excess free cash, dividends, buybacks, and sustaining that peer-leading dividend growth rate that you highlighted in the slides?
Yeah, so, I mean, dividend reduces through the time period. And that's because the cash flow, generation that's coming from the assets that are online. So the cash engines today, TCO, Permian, Gulf of America, Australia, and then the growth that's coming. So the free cash flow is growing, and so we see dividend coming down with that.
Break even.
Break even coming down with that. And so sub 50, I think you can expect somewhere in between the 40s through that period. And in terms of what we'll use that for, obviously, we have a commitment to the dividend. So to sustain growing the dividend, that's our number one financial priority. So we'll be guided with that. We'll look then to our second financial priority, which is what investments we need to make in the business. Third, we'll maintain a strong balance sheet. And then fourth is steady buybacks through the cycle. So as we see cash generation grow through that period, you can expect us to be steady through the cycle, consistent with the range that we've provided.
Take our next question from Doug Leggett at Wolfe Research.
You've got one coming, Doug.
Thanks so much. Mike, I wanted to ask you about M&A.
Pardon me?
Because the statement you made was, I think, was quite prescient when you said, what hasn't changed is our approach to valuation. 10 years ago, you were exploration-led, organic-led. In the last 10 years, you've been M&A-led. How do you see that mix changing beyond what you've laid out today? Because obviously today is what you've already secured. So I guess the question is, what happens next?
Yeah. So Doug, the way I think about it, there are really three different ways that we bring resource into the portfolio, convert it to reserves, and then produce it and turn it to cash. One is through exploration. We find resource that we hadn't known was there before. The second is through acquisition. We can acquire resource. And the third is through technology, where you unlock resource that you currently have that's not economic today, but you find ways to go out and drill in deeper water to reduce development costs in the deep water, to improve recoveries out of shale, to de-risk additional benches, and you can use technology to bring more resource into the portfolio. Over time, we rely on all three of those, and all three of those have delivered consistently. At any given point in time, they won't be a third, and a third. And so we have had at times, if you go back a couple of decades ago, where we had a very strong track record in exploration and a lot of resource that way. The last period of time, we've used M&A. Through it all, technology has kind of steadily continued to march forward and contribute. Going forward, we're rebuilding our exploration portfolio. We're bringing new tools to bear, as you saw in the opening video, and Mark will talk more about that. We've brought new talent in from both Hess and a new hire to run our exploration program. And I expect better exploration results. I expect more resource commitment to exploration, both human resource, technology resource, and financial resource. And from that, I expect to see more contribution from exploration. On M&A, it's always a bit speculative. We've had a nice set of additions that we've done over the last several years at a company level. The thing that is interesting today is there are a number of opportunities out there in terms of new country entries. We've had discussions underway that have been reported in the media, so I can acknowledge these in Libya. We've had discussions in Iraq. The interest on the part of the government is strong. The suite of fiscal terms are more attractive today than historically they have been. And so you may see in the acquisition category a little more at the asset level or country entry level than you've seen over this last period of time, because the opportunity set today there is more interesting and attractive than it was a decade ago. And so it'll be a mix over time. You've got to be good at all three of those. You have to invest in all three of those. And over time, we need to see contributions from all three. Thanks, Doug.
We'll take our next question from Sam Margolin at Wells Fargo.
Hi, thanks for all the materials. I'll ask about power. These are really unique investments in the peer group, and I think they've been enabled by some of these upstream reinvestment needs that are coming down. So I guess these are big orders on the turbine side. If you could just talk about how that capital fits into the overall CapEx framework, and then ultimately what the value proposition is with the power assets, because not only do you generate income from power, but it's transformational to some of your gas assets too, potentially, depending on how it's put together. So.
Yeah, so first of all, welcome back, Sam. It's good to see you. And I don't want to get too far ahead of Jeff, because I think he's going to want to share some more on this in his section. But maybe at the highest level, the capital is going to fit into the range that Eimear just talked about, and the range that's lower than it had been historically. So our plans account for that. We've got a partner. We may look at different financing alternatives in there, but we've accounted for it in our capital budget guidance. The value proposition is interesting because we've stayed away from power to this point other than for our own needs, and that's both traditional power as well as renewable power. We didn't want to go into the merchant power generation business. We don't have any unique capabilities in renewable development. What's different is, with the 5 gigawatts that we currently operate every day to keep our facilities operating high levels of reliability 24/7, 365, we've got a new customer class that has emerged that has that very same profile. And we've got a lot of experience in doing this. We've got access to resource. We've got a high performance customer that's ourselves at Kazakhstan and Gorgon and other facilities like that. And importantly, in these places where we got this experience, we're not reliant on the grid. And as you all see every day, power prices in this country are a real issue today. And so being able to help support the very necessary buildup of data centers, because it's a national imperative, it's a competitive issue between the United States and China, but doing it in a way that doesn't unduly burden the consumer is increasingly going to be important. And so we have unique experience in doing that, in building at scale, in operating at scale, and in doing so in a way that doesn't put the costs into the rate base for the average citizen. And I think increasingly in this country, we're going to find the imperative for speed, the desire for scale is going to bring us back to natural gas. And this issue of being able to do it without laying the costs out across the broad rate base is very important. So that's the model we're pursuing. The contracts, Jeff will talk a little bit more about it, but they'll look more like an LNG, be PPAs that'll look a lot like a long-term LNG contract. We'll have certainty of cash flow. We're only going to make final investment decisions if it's underpinned by a competitive return. But we think there's an opportunity for us to be part of that. So Jeff will share more with you in his segment.
Take our next question from Paul Chang at Scotiabank.
Where is Paul? There he is.
Thank you. Mike, I want to go back into the one comment you make during your prepared remark. You're talking about how the process and organization have changed that led to the much lower cost. If we look at over the past 10 years, your headcount reduction is about 1/3, and you have made a number of acquisitions, and then your headcount naturally should go up. So can you talk about that? How dissect it? I mean, what % of the improvement is really from the new technologies we've been able to do? And what % of the improvement is really changing the organization or the process, how you conduct business? And if you can talk about what change that is the biggest change that lead to this kind of pretty drastic improvement. Thank you.
Yeah, I'll talk about it at a high level and then let Eimear talk a little bit more about some of the specifics. You're right, Paul. The slide I showed that was 10 years ago versus today, we're a much larger company on many different dimensions, and yet our costs have been relatively flat, and our headcount has come down by like 1/3 over that period of time, from the mid 60,000s down to the low 40,000s. Much of that is through a combination of organizational structure, technology, and the pursuit of efficiency. But it was all grounded in a legacy organizational structure that was very devoted to autonomous business units around the world that had the authority on the ground to make a lot of decisions, that had the resources necessary to operate. And if you go back a long way in time, that was how our industry had to evolve, and particularly in some of the far reaches of the world. We have had historically centralized some back office functions into service centers in the Philippines and Argentina. But much of our technical work still went on very much in business units and out close to the action. We hadn't centralized as much of that. That's a big change in what we're doing today. We've also organized our upstream businesses along the lines of asset classes more than geographies. And so all the shale businesses are together, be they in Canada, the US, Latin America. All our deep water businesses are together, no matter where in the world they are, to drive efficiencies, best practices, standards, and resource optimization. And then we're moving technical work to centers of excellence. And so we're on this journey that Eimear talked about, where we will continue to see further efficiencies and reductions. And we're not yet banking a lot of this on things like AI taking more cost out, which I certainly expect we will see over time.
Yeah. So Paul, within the $3 to $4 billion program, we have three focus areas. The first one was costs reducing due to divestments. So think of that as the portfolio rationalization that we've been doing. And so we're already seeing those costs in the bottom line. We're seeing lower upstream OpEx costs given the divestments last year, for example. So think about a $1 billion of the 3 to 4 there. The second area is what Mike talked about, is this operating model change where, like assets that are brought together, I mean, we're just seeing the power of procurement across common assets versus, discrete, decentralized assets. That would be one example. How do we bring supply boats together for offshore? How do we think about contracting differently? So the standardization and centralization as a result of the organizational change that we've been through in the last year was initially $1 billion of a cost reduction target, and that focus area is actually delivering more results than we expected. So by the end of this year, we'll have already achieved $1 billion of that. So that's why we feel confident that we can raise the target, because we're seeing more there. And what I would say around all of those efficiency improvements is we've got this relentless focus on benchmarking. So what can we learn from other assets in the portfolio that can help assets be more effective and efficient? What we can also learn from industry. And so we've got a culture of that going on as well. So that's the second focus area. And then the final one to your question on technology, we have numerous examples of where we're seeing costs reduce. I would point to two, digital twins that you saw on the video. So the way we use these digital representations of our assets to do work through that digital interface versus having to send teams on the ground to do planning excursions for turnarounds, example. We're seeing in our turnaround costs and in our movement around our competitiveness there being enabled by technology. Another good example would be how we're using drones and robots to inspect tanks. So previously that is manual intensive, high-risk work, and we're using that technology. So that third focus area of technology is really an area where we're seeing the green shoots, more than green shoots in fact, and we see much more potential in there. And that gives us the confidence in raising what was a $2 to $3 billion target to a $3 to $4 billion target today.
Next question will go to Arun Jayaram from JP Morgan.
Yeah, good morning. You talked about the portfolio resilience with the less than $50 break even. Could you talk about cash return guideposts around a $60 to $65 Brent environment?
Sure. So our intent is to be steady through the cycle. So you can expect us to be buying back shares within the guidance that we provided, 10 to 20 billion. We've changed the price point at which we can deliver those buyback programs. So at the lower end, it's 60, but at the upper end, it's 80. And so that points to the cash generation, the growth in cash generation. We can deliver at the high end of the buyback guidance at a price that's $5 lower. So that's how to think about just overall the range and the price points that we tie to the range. In a world that's 65, so a world like today, you can expect us to stay where we are today. I mean, it's not something that we jerk around, and we were normally very prudent. We look at the context, how do we see the price outlook? Is it structural? Is it more of fundamental-led? Is it a long-term? Is it more temporary? If we were to change where we are today, given the rate that we're at, 2.5 to 3 billion a quarter, we'd take that into consideration, the outlook, along with just cash generation and the investments that we'd be making. But you shouldn't expect us to be outside the range that we're in.
Next question, we will go to Biraj Borkhataria from RBC Capital Markets in the front.
Hi, thanks for taking my question and thanks for the presentation. I wanted to follow up on the resource access point you touched on, and you mentioned the sort of improving fiscal incentives and terms. So 2 questions related to that. One is, what do you think is driving that change, that step change? And secondly, how competitive are these sort of negotiations, tenders, or processes? Because it feels like there are only a small handful of sort of global international companies that can benefit from that step change, of which you're one. So just some reflections on that would be helpful.
Yeah, so these things can kind of swing a little bit, I think, in cycles, Biraj. I cited the Middle East because it's a place where we see the most activity, and our business development team has been spending the most time. And there are any number of countries. I named 2, but there are many more than that we've been in conversation with. One thing that I will tell you is the change in administration has sent a signal. It sent a signal relative to countries that would like to see American investment come to their countries. And of course, there's been many announcements and reports of investment from other countries coming to the U.S. And that's a real change in mindset, I think. It's a change in what we've seen in many of these places in terms of their desire to work with American companies. And so there are only a few companies with the scale. Obviously, some of these resources require technical capabilities. I mean, we mentioned TCO earlier, but you get into high pressure, high temperature, sour gas, certain types of environments. There are very few companies that have a demonstrated track record of working under those conditions. And so it's very attractive. We'll see how these negotiations play out. As I said, there are more of them that we're talking to than we'll be able to actually follow through on. But they're attractive. They're diverse in terms of the type of resource. We're talking about both oil and gas. We're talking onshore and offshore. We're talking about some discovered resource and some exploration prospectivity. And so it's a very interesting landscape that we find out there today. Thank you.
We'll take our next question from Paul Sankey at Sankey Research.
Thanks, Jake. Mike, we were talking about 20 years ago, your first analyst meeting here at the St. Regis, when Chevron had 2 million barrels a day of refining capacity, and you were the architect of taking that down to the 1 million barrels a day that you're at right now. In terms of the business shape, you express, I think, no interest in getting bigger again in refining, although that seems to be the current bottleneck globally, but an interest in getting into chemicals, where we've seen all-time low margins effectively, or very poor margins. Do you think that this announcement for AI to the 2,500 megawatt plant that you're talking about in Texas can be the next leg of the industrial reshaping of Chevron? Or are you going to kind of stick with this upstream focused 2-3% growth plus cash return as the industrial shape that you want? And I guess the follow-up is, could you see yourselves doing a mega deal in the context of the Trump White House as perhaps the opportunity to do something generational?
Yeah, so I'll answer your first question, Paul. And look, I love our refining business. Our refining business is highly competitive. I don't want to say that we would never do something in refining, because if it were the right opportunity, we could. But we've long had a view that we want to be a more upstream-weighted company, and we've shaped the portfolio accordingly. We've got a big downstream. It just sits inside a company with a much larger upstream. And so I think you can expect to see that overall portfolio weighting continue. Chemicals are in a tough part of the cycle right now, but the demand, the long-term demand for the things that we all rely on in our everyday lives is inexorable, and we'll see in a classically cyclical commodity business, petrochemicals will come through the trough, and long term, we believe there will be good returns there. The opportunity in power, I think, is to be determined. It could become a much bigger part of the industrial model for the company going forward, but I don't think we can say that today. We certainly see an interesting opportunity. We're leaning into it right now with some big commitments on equipment. As I think I mentioned earlier, we've got a site identified. Some of the stuff's been reported in the media. You quoted a capacity which is probably in the ballpark of where we would start out, which is big for power generation. And we've got more turbines than would be required to deliver that on order. Firm deliveries, speed matters in this. There's a great appetite to move. There's supply chain constraints, particularly around turbines, both large and the smaller block turbines as well. So we think there's an interesting opportunity there. We're making good progress. We'll see how that unfolds. I think it's worth giving it a shot. We've laid out some other bets to create options, if you will, in things like lithium that could become part of that over time, where there is clearly natural market demand as opposed to demand that's created by some policy that may be here today and not be in the same form tomorrow. So we've got options across a number of these potential new avenues for us to build out our energy business and be part of the future of energy. But at the core, I think our upstream business, even the IEA now believes that the world's going to be using more oil and gas for longer than a lot of people thought not too long ago. And I think you have to know what you are. And at the core, that's who we are. And we intend to be very, very good at that for a long, long time to come. Thank you.
We'll take our next question from Nitin Kumar from Mizuho.
Great. Thanks for taking my question. Mike, Eimear, I'm hoping you would be willing to unpack a little bit of the trajectory of the free cash flow that you're growing. If you look at it, it's about $10 billion, but you have a pretty good head start between $1 billion of CapEx coming down. I think you mentioned $3 to $4 billion of cost savings. TCO is so. If you can help us just think about the trajectory, like if you get to 40% or 50% of the target in the first couple of years, is that how we should think about it?
Yeah, I think in the next 2 years, once you've got a year of FGP online, a year of Permian at 1 million, the Gulf of America will have fully ramped up its 3 major capital projects to 300 million. So those, 3 large catalysts, they're pretty significant. So you add those, and you're at, versus where we are today, about 17 for the year, and you'll get to 24 pretty quickly. And so you can expect between 27 and the end of the time period to get to the 29, 30. So that's how the growth breaks down. More in the next couple of years, but still steady growth through the end of the period. And that's production growth, and that's only from upstream. But as I said in my previous comments, it's more than just production. It's margin growth as well, because our portfolio has got more oil weighted, and our portfolio is also lower cost. And so when you couple the production growth with the margin expansion, you get a significant catalyst from upstream. On the balance of the portfolio, downstream, chemicals and power contribute as well, to a lesser extent, 3% versus 7% from upstream. But those are the key building blocks around production, cost, and the portfolio.
The specific assets you might just note for that back part of the 5-year period would be 4 more FPSOs coming on in Guyana. We've got 4 online today. There'll be 4 more. There'll be 2 big petrochemical plants come online, one in the U.S., one in Qatar. You'll see Eastern Mediterranean expansion projects come on with gas, both Tamar and Leviathan in the near part of the plan with smaller increases in Leviathan with a larger kick up in there. Argentina starts to contribute more, and then the power business will start to contribute. So there's a number of discrete projects and assets that you can look to. Jake and team can give you a little bit more to fine-tune your models on those. Thank you.
Take the next question from Ryan Todd at Piper Sandler.
Good, thanks. In the slides there, you have a chart showing the last couple corporate transactions that you did at PDCE and at Hess with a 50% increase in synergies of both of those. Can you talk about, as you look back on these last two transactions, what are the things that have gone well that have helped you drive synergies at higher levels, and maybe specifically for Hess, what are the things that have been positive surprises, and what are some of the opportunities going forward that may open up?
Yeah, I'll make a couple of comments and then let Eimear give you some of the numbers. There have been no negative surprises, and sometimes when you unwrap an acquisition in all its glory, you find a few things you weren't banking on. We haven't seen anything like that with Hess, so it's all been positive. The thing to me, in addition to strong asset performance, that has been the most rewarding and encouraging, but not surprising, is the quality of the people. And they're just excellent. And whatever part of the portfolio you go to, Gulf of America, Bakken, the team working in Guyana, the exploration team, these are first-class individuals that bring exceptional talent to our organization. And that talent will deliver value beyond just the assets that they came with. And we're already seeing it. I'll talk about exploration, where Mark will share more about the changes. Our exploration model, our technology, our theories on play types, our assessment of some of the frontier basins that we've entered have all been interrogated and improved by a new set of eyes and a new set of experiences being brought to bear that see things differently than our team would have seen them. And so there are synergies we can quantify. We've talked about put options and net operating losses and costs, which are all very real and tangible and financial and bankable. What's a little harder to build into your models or our assessment of value is what value will be created by bringing in these people and the talent. It's very real. We've seen it happen before. And to me, it's the part that is the most encouraging.
Yeah, maybe I'd build on just what we're seeing as we've integrated Hess and the increase in the synergy target that we announced today of an additional $500 million has really come from what Mike talked about, the talent. We call it the best of both. So there's so much that you can see before the transaction is closed, but when you bring the teams together, that's where more insights has been developed. And specific to Hess, as we've brought our Gulf of America portfolio together, would be an example. We've found ways to do our contracting differently, to provide operational support in that area differently. And so some of the synergies that we shared, the part of the synergy target that we updated today includes some of those. And we have clear line of sight already, not even a few months after closing. Another example, as we brought the shale and tight businesses together. So as part of the reorganization, we pulled all of the assets together, Argentina, Permian, DJ, we're now bringing in Bakken. We were able to think differently about how do we source fracking for a much larger portfolio. And in the shale and tight business, we moved to a single contractor there, and immediately we get the synergies. So we've line of sight on that too. And then in addition to that, we've got development plans and learnings and best practices that we can share and optimize, and we're seeing some of that as well. And we're able to still develop the fields, but maybe do it differently, whether that's with longer laterals or a different development plan or a lower number of rigs. So those are real examples of why we feel so confident in adding to the initial $1 billion of synergies today and raising that to 1.5. We're not hoping that it happens. We actually have line of sight on all of it. So thanks, Ryan.
Take our next question from Steve Richardson at Evercore ISI, right here in the front.
Thanks. So you're outlining a view here with a lot of opportunity upstream and a deep asset bench, and at the same time you're holding yourself to a certain amount of discipline on the capital side. So can you talk about how you've institutionalized this view? Because I'm assuming what's implying is as these other opportunities come in, is that there's constant high grading going on, and you're kind of holding yourself within this envelope, but at the same time, we all know commodity price, opportunities, things come and targets go by the wayside. So can you talk about how institutionalized that is and how you think about that over the next couple of years?
Yeah, I'll make a comment first and let Eimear follow. You know, there's really two ways you can deal with these things. You can either expand the capital to absorb all the opportunities, or you can constrain the capital to high grade the opportunities. In the past, we did a little bit more of the former than I think we probably should have. And so today, you know, we've been very, very rigorous in terms of setting guidance around that, in terms of creating a lot of transparency internally, much more than we used to have, to early stage project development and putting projects in front of a joint team of senior leaders of the company who come from all the segments, so you don't get advocacy for particular parts of the company or particular projects that goes too far, and you get to a point where it's more difficult to say, no, sorry, we're not going to do that. So there's much better early phase transparency. There's much better cross-segment vetting of opportunities. And what I'm finding is that leads to higher quality project development, more honest conversations early about the potential downsides of projects, or where are we taking on a lot of risk. And we're finding that the high grading process, when you engage people transparently with clear expectations, they actually come to the table and engage in really good conversations about the trade-offs, the priorities, and where the capital should flow, because at the end of the day, they're all shareholders too, and they're all employees. And so we've really taken a different approach, an enterprise approach, to earlier stage project reviews and vetting, and ensuring the things that are moving through the pipeline, where you start to get to a point where you're making more substantive commitments, are things that have seen the light of day, and that you don't get yourself to a point where you're, you know, half pregnant on so many things that you start to say, well, we ought to follow through on this, we ought to follow through. There's more value destroyed if we stop. So we're killing things earlier, but there's a lot more transparency, and you've been in those meetings for years now.
Yeah. I would point to two things here. Not everything gets funded, period. There's a lot of opportunity. I mean, we have more opportunities in the hopper than we fund. And it's that rigor that Mike talked about. We're returns focused. We need to see the returns. We need to test every investment at a range of prices, because that's our reality. These have to be accretive in low prices as well. And so we're really focused on that, and very, very rigorous. And I think the organization has got used to that you know, there's a high bar for investment. So I would say that's one thing that we have institutionalized. The second thing is we also look at, so how can we get more value with less capital? We put ourselves through that process. We don't just accept. And what we've learned is that there are different ways to design solutions. Some solutions can be the maximum design that covers every possible scenario that you can encounter in an asset. Others are more minimum functional, and they maximize value. And so what we've tried to institutionalize, in addition to the discipline, is discipline around look at the minimum solution and design the minimum, and then justify every enhancement beyond the minimum, so that we know exactly what we're investing in, and that we can see the value in all of those enhancements. And I think those things are things that we have, that are alive and well in the organization today. And that's why we feel confident that we can have the portfolio we have today, we can support the investments that we have today, we can deliver the free cash flow growth, and we can do that with less capital than you know, we had previously guided to.
Take the next question from Alistair Syme from Citi.
Thanks. I know the price outlooks you show aren't forecasts or planning assumptions, but I was intrigued about the use of $10 LNG JKM against the $70 oil forecast or oil outlook. So maybe use that to sort of tee up your view on the LNG market, and how does LNG compare to the power opportunity in the Gulf Coast?
Yeah, so LNG's been interesting over the last few years as Europe has gone through a recalibration on gas supply, as the U.S. has become the largest LNG producer in the world, as we've seen Qatar decide they want to step back into expansion, and we certainly see over the next several years an awful lot of supply coming to the market and demand growing, no doubt about it. But if all the supply that's in the queue were to arrive, you see a market that's going to be oversupplied for a period of time, and that would weigh on spot LNG pricing. And LNG markets years ago were tightly linked to crude markets. That's linkage has somewhat diminished, not entirely, but you're seeing a lot more gas-based LNG pricing in the world now with different indices. And so, we've got I think a view that in the fullness of time, so you get out into the 2030s, and LNG markets, just as I mentioned earlier, petrochemical markets will rebalance over time because the old axiom that the cure for low prices is low prices still holds true. But I think spot markets will be pressured for a while. 80% of our portfolio is oil linked today, and I expect us to continue to seek out predominantly oil linked pricing. We do some other sales within our portfolio, but crude on the other hand, once we get all the OPEC plus supply back into the market, you're seeing non-OPEC supply grow, but you can see that growth attenuating as well. I think crude markets firm up a little bit before LNG markets, as LNG markets cycle down, and it's unusual to see things that we've seen only maybe once or twice over the past couple of decades, where across the commodity basket everything is tight at the same time. It's why we want to have a diversified portfolio in terms of asset class, geography, customer mix, and all the rest of it. And so, that's our current view, and you see it represented there. And those are not forecasts; those are kind of planning assumptions for the purpose of guidance.
Take our next question from Lucas Herrmann at BNP Paribas.
Jake, thanks very much. And Eimear, I just wonder if I could touch on balance sheet for the moment and the way that you now think of it. I'm not quite sure where your range in gearing terms is or what the objective is around, the rating. Clearly, at the present time, projects are ramping, but you've got the incremental cost associated with the Hess dividend, and there's a lot of volatility and uncertainty in the market. So, simply, when we model, how do we think about the constraints that balance sheet presents, to your return to shareholder approach?
Yeah, thanks, Lucas. So, first of all, what I would say is maintain a strong balance sheet. It's our number one financial priority. So a lot of focus always on the balance sheet and maintaining its strength so that we have that strength to weather all prices, given just the nature of our business. That's point number one. Two, we're in a very strong position today. So the balance sheet is really strong. If you look at the coverage chart that I shared during my presentation, and so here we're using this metric, the net debt over cash flow from operations, less than 1, less than the average of the peers, less than the S&P 500, very strong position with debt capacity, ample debt capacity. And I would give you, 15 billion of capacity right now in a world that is a $60 world for 5 years. So, you can expect us to always be focused on the balance sheet. And overall, we have a AA credit rating, and so very, very strong. And with the credit rating that we have and the cash generation that we have today, and the growth that we see greater than 10% over the plan period, we'll be able in a $60 world with our balance sheet to maintain $10 billion of buyback through that period and keep it AA.
We'll take our last quick question from Jason Gableman at TD Cowen.
Yeah, hey, thanks for squeezing me in. I had a question on the CapEx range, 18 to 21 billion, and I think in the past you've been, much more levered to shale growth than we've thought, and less so to, I guess, exploration success. So in the past, we've thought that CapEx guidance has been probably more impacted by oil price than portfolio opportunities, and I wonder, looking forward, if that's changing, given there is less shale growth in the plan and more potential on your exploration backlog. Thanks.
So what I would say, I think there's a slide where we show our sources and uses at different prices, and you'll see that in both of those scenarios, CapEx doesn't change. And that's because when we look at our investment choices and decisions, we test everything at high and low prices. So we don't like to move capital around. Our investments have to withstand lower prices and deliver the returns. So don't expect us to start changing our capital program just because we see prices slide a little bit, below where we are today, because we've already tested the robustness of those investments at lower prices, bar something that we would never be expecting, like another COVID. I mean, we're in that scenario, we did cut capital. You should not expect us to move that around, Jason. Thanks.
Okay, I think we are at the end of the first part of the meeting, so thank you for the questions. We're going to take a brief break now, I think 15 minutes, and then resume with presentations from Mark Nelson, Jeff Gustafson, followed by another Q&A session. So we'll see you back here in 15 minutes. Thank you.